All right. My guess is you probably didn't do well because this is tough stuff and you just seen it for the first time. But it's going to be really helpful to go through these so you can start. Part of this is knowing the concepts. Part of this is understanding my charts, which you're using on the paper. So both are important things. Also, you got the exam coming up, so you got to make sure you're reading these charts correctly. All right. So let's look at the question and I'll give you the answer. So this first one, this is what people are still struggling with. Negative is good or bad? Negative is better. So if it's negative, the company's definitely liquid. Then you just want to know the trend. Are they getting more liquid or less liquid? So positive doesn't mean they're illiquid. It just means they're normal. So then the question is, are they getting better or worse? So better always means going lower, whether it's a positive number going down or a negative number going down. Lower is always better. All right. So this firm did what from 2012? Well, first of all, is it a source or a use? Source. Are they getting better or worse from 13 to 15? Better. And what's happening since? Deteriorating. All right. It's not a use of cash, not a use. It's been improving since 2015. Is that right? No. So what answer? D. All right. So yeah, D is the answer on that one. All right. Number two, same thing. Is it a source or a use? Well, both. Okay. So it started as source, ended up use. All right. Was a use until, that's not true. Was a source until, but it's come a use. So B sounds pretty good. Now, some of y'all will do this in your paper. The work capital spike was caused a large issuance of debt. There's no debt in working capital. There's no debt in cash from operations. There's no way debt can impact this number. All right. Some students do that. They think, oh, if I talk about debt, I'm bringing some really good analysis in. Well, no, it has nothing to do with this data. All right. The last one with the typo, the negative working capital requirement is probably due to poor management. No, it's probably good due to good management because it's a source. All right. Receivables and inventory would be the culprits. You could, you know, if I'd said the deterioration was due to poor management of receivables and inventory in these years, that might be true. But I didn't. I said these years it was poor. All right. So that one was B. Anybody 100% so far? The team, yeah, Michaela's team so far. All right, now this one's a little tricky. There might be more than one possible answer here. But first of all, is it a source or a use? It's a use. These dollars are all positive numbers. Do you want working capital assets to grow faster or more slowly than liabilities? Which would be better? More slowly. You want the growth in the assets be less than the growth in liabilities. That means they're improving. It was 4.7 billion. Now it's 4.4 billion. What's confusing is 2018 was kind of a strange year where their working capital came down, but as a percentage of CFO, it went up. That must have meant their CFO dropped. So you have to be aware when you're looking at this ratio, there's two things in it. There's the working capital requirement and there's cash from operations. It's possible cash from operations did something strange, and that's what's causing this ratio to be a little bizarre. Some of your companies are doing that to you. Remember, I said if your company's cash from operations was negative, that's just not going to work as a ratio. All right. So this is a good thing that the assets are growing more slowly than liabilities. It is a use. It's growing at a fairly slow pace, but it's a use of cash, but it has improving because assets are growing. A sounds like a pretty good answer to me, but let's see what the others say. It's not a source, so we can kick that out. That's pretty obvious. Is a use, but has been deteriorating. So you have to kind of throw 2008 out. I'm going to say it's been improving because it went from 4.8 billion down to 4.4, and it went from 92% of cash from operations down to 64. So I'm going to say improving. The one red herring is that this is a positive number. That may have thrown some of y'all off. So it is growing, but as percentage of cash from operations, it's not growing. So what does that mean? Well, you expect it to grow, but it's not growing as fast as the rest of the business. So to me, that's improving. I think it's improving that the assets are growing more slowly than the liabilities. That's my indication that it's improving. All right. So I would not call it deteriorating. Net working capital is a source. That's not true. So I would probably go with A, but let's see what I answered. I can't remember. Yeah, A. Anybody get A? That one's, I may give y'all kind of depending on what you said. So
what's the difference market and the network?
all right, so this is your net working capital of 4.4 billion. This 64% takes this 4.4 billion and divides it by your cash from operations. So there may be some bizarre thing. Remember the other changes in cash from operations, that can be a big number sometimes. It may be that your working capitals are getting better, but this percentage does something weird. Just a good example is 2018. It improved dramatically, didn't it? 4.4, but the ratio went up, which is bad. There's probably CFO probably dropped for some other reason. And that's why I like this chart, because you have to just remember here, we're dividing by CFO, which means there's something in this ratio could have nothing to do with working capital requirement because something strange happened to CFO. So I just wanted to see that because that could be happening with your company. All right. Tricky question on that one, but all right. Now this one's a hard chart to read. Below the line means they're either issuing stock or borrowing money. Above the line means they're buying back their stock or they're paying down debt. All right. Very, very important that you interpret. This is a pretty strange chart. All right. You can kind of tell from the description, it says bond repayment or negative number issuance. Stock repurchase or negative number issuance. So above the line means cash is going out of the firm, which means they must have good free cash flow or they wouldn't do that. Below the line means there's some reason they're short of cash and they need money. So what did they do in 2017? Did they pay down debt or did they borrow money? Yeah, they borrowed here. That's borrowing. What did they do in 2012? Did they issue stock or buy back stock? They bought back stock. Okay. They have a very stable buyback strategy. Does that look stable to you? No. Has a very stable dividend policy. Does that look stable? Very stable. But a very unstable stock buyback and debt issuance. They paid back debt in 2015-17. Does that sound right? They actually borrowed in those 2 years. They borrowed a lot in 2015 and 17 and paid it off in 18-19. Does that look correct? That looks, C looks pretty good. They issued stock in 18 and bought it back in 19. It's the exact opposite, isn't it? All right, so C looks pretty good on that one. C, good. Michaela's team's looking pretty good so far. I think you're 3 out of 4, right? So far, that's really good. I'm surprised. I wasn't not her. I mean, I'm surprised. You know, all teams. These are hard questions. You just saw this last week, right? So if you're understanding this, you're very impressive. All right, so same thing here. They rarely buy back its stocks. How does that sound? False, right? They buy their stock back a bunch. Emerson's, none of y'all picked Emerson. Emerson's a really good company to do for this. It's a very interesting company. Emerson has made large stock purchases, especially in 2015, which is a sign of weak free cash flow. Is it strong or weak cash flow? It's strong, right? If they're buying a lot of stock back, they must be producing a lot of cash because that's something they don't have to do that. The fact that they're doing it must mean they have a lot of confidence and they're buying. So B looks pretty good. Had some large stock repurchases and consistent dividends with limited issuance of debt. The net cash flow outflow to stockholders and debt holders is a sign of very strong free cash flow. The limit, I don't know which one. Yeah, that one. So B we kicked out, right? Because it said weak. So C sounds like it's pretty good. Yeah, I was thinking I said stronger, but that says weak. All right, so maybe C sound good. They issued stock in 2019 in order to pay down its debt. Does that look right? Did they issue stock in 2019?
No.
And they bought it back and they borrowed. So it could have been the opposite. They could have borrowed money to buy their stock back. C looks pretty good to me. So C, wow. Are y'all all doing as well as Michaela's team? Wow. All right. Y'all are impressing me. That's good. I mean, I expect you all to impress me, but this is really good. All right. Components of CFO. So here, the entire bar is cash from operations. The blue is just net income. So here you see there's net income. Cash from operations was much higher, which is the norm. Why? Because you're adding back depreciation. So most firms, their CFO is higher than their net income because you're adding back depreciation. And you notice depreciation is the most stable one there for most firms. Their net income is usually larger than cash from operations. That's not true. All right. The net income's the blue line. Depreciation and amortization are very consistent reduction. Now I didn't word this very well. What I'm saying is you took net income and you subtracted depreciation in order to get cash from operations. What did I actually do? I took net income and I added depreciation back to get the cash from operations. So I just didn't word that one very well. So that one's not correct. The last few years, the change in working capitals has been added back. Let's see if that's true. Where is this green? Subtraction, added, subtraction, subtraction. No, it's actually been deducted. Implied net working capital is the source. So it's actually, if it's below the line, it's a cash outflow. So it means it's a reduction. So C doesn't look good. Other differences has been quite volatile. And it has been, you see other differences. Man, it jumped a bunch in 2008. That raises red flags. Yeah, I would think so. So if you have a firm that the other differences is huge, you don't necessarily have had students ask, you need to go back to 2012 and see what happened. Not necessarily. I do. I'm a finance person. So, and if you're an accounting major or finance person, if you're like I am, it's like, yeah, but I just want to know. I'm really curious, right? It's just kind of plagues you until you figure it out. So this one, I would probably go back to 2018 and see what did they do. So what could that be? They could have funded their pension plan. That's something that's not working capital, that subtracts net cash from operation, doesn't affect. Another thing could be a realized gain. Realized gains are really interesting. So you accountants, see if you can understand this. If the firm sells another entity, it has a large gain. Let's say they sell a segment and they have a $500 million gain. That gain increases net income. But when they sell it, that entire sale goes for cash for investing as an inflow. So you already have the entire sale and the cash from investing, including the gain. So what you have to do is you have to subtract that gain from cash from operations so you don't count it twice. All right, they sold it for $1 billion. That entire $1 billion is an investment inflow, including whatever the gain was. So you have to subtract it. So if they sell a segment of a big gain, so that would be a subtraction for other, that wouldn't be such a bad thing. It's really just fixing your cash from operations. So no telling what that is. They're usually pretty easy to find. You just go to the cash from operations and just look for some large thing that jumped out in that year and you say, oh, I see what they did. That looks interesting. All right. So I would probably say D on that one. That one probably, a lot of y'all missed that one. You might get that one right. That's a confusing question, right? So if you got it right, you might have understood it, or you might have just guessed. We'll see. All right, Cisco systems are CapEx. Again, this is a difficult chart because I'm dividing by CFO. So it could just mean their CapEx could have been flat and their CFO is growing. But we're going to assume it's CapEx that's causing this. So are they investing more into the firm or less into the firm? Is it going up or going down? Going down. So it looks like they're reducing their reinvestment into the firm. That's what CapEx is. They're reducing their outstanding debt. There's no debt anywhere on this chart. There's no debt in CapEx. There's no debt in cash from operations. So that doesn't make sense. They have generally been reducing reinvestment of cash from operations in the company, which means they're using less of the firm's cash flow to purchase large assets. That sounds good to me, but let's see. Their profitability has steadily declined. There's nothing about profitability in here. Cash from operations is not profits. CapEx is not profits. There's no profitability in here. All right. CapEx and store expansion appears to be a priority. Well, if it was a priority, what would it be doing? It'd be going up. And Cisco doesn't have stores. When's the last time you went to Cisco to buy something? It doesn't have stores, right? They sell servers and all those kind of things. So I would think B would be the right answer. So B. So if CapEx is going up, well, if CapEx is going up, this line's going to go up, whether they borrow or use cash from operations. I mean, you don't use cash from operations by CapEx. CapEx goes through investing. But if they have a lot of cash from operations, they could use some of that for CapEx. So these are coming from two different parts of the cash flow statement. CapEx is a pretty important number. This is a small number, 10%. You kind of have to ask, what are they doing with the rest of their cash from operations? They're only spending 5% of the cash from operations. Are they buying other companies? Are they buying back stocks? What are they doing? So that's a pretty small number. Some of your companies' CapEx is 50% of cash from operations. Some of your firms, your CapEx may be more than 100% of cash from operations. So Manuel, that's when they probably borrowed money. So if their CFO is $1 billion and their CapEx is 1.5 billion, they probably had to borrow $500 million to do that CapEx. All right, y'all are understanding this really well. Y'all are a smart class. That's good. All right, times interest earned. What can we do when you see a percentage sign? Throw it out. All right. Times interest earned is not a percent, so you throw it out. Be careful on your paper. You don't say 10% or whatever. It's 10 times. All right. So we can kick out C and D. Their ability to repay their debt and their ability to repay their debt. So that's correct. For times interest earned, it's ability to repay debt. Debt to EBITDA is not ability to repay debt. Okay. Debt to EBITDA is your amount of debt. But times interest earned is your ability to repay your debt. All right. So always keep that clear. Their ability to repay their debt is deteriorating since 14 through 17. Is that right? That is correct. Times interest earned higher is better, but has been improving since then. And in 2019 is now strong, surpasses 10. Yeah, 10 is a good benchmark. They did surpass 10 times. Yeah, A sounds pretty good to me. Their ability to repay their debt improved significantly from 2014 to 2017. Did that improve significantly? No. And has been deteriorating since and is now very weak, given that. So this is going the exact opposite. It's saying higher is worse. No, higher is better here. Okay. So the answer there, I guess we said was A, right? All right. How are y'all doing on that one? All right. Not so well on that one. Okay. Debt to EBIT. Now, debt to EBIT is not ability to pay debt. It's the level of debt. So you can kick out A. So their level of debt appears reasonable compared to the industry. So that does seem reasonable. Seems like it's right in line with the industry, doesn't it? Their level of debt appears reasonable compared to the industry, but weaker in 2019 than Johnson Controls. All right. Are they weaker or better than Johnson Controls? Now, times interest earned, higher was better. What do you want here? Lower is better. So are they better than Johnson or worse than Johnson in 2019? They're worse. All right. So B looks like it could be possible. Their level of debt appears reasonable compared to the industry, but stronger than Johnson Controls in this last year. 2000. I should have put 2019 on C. Train's level of debt is much more volatile. Who's more volatile? Johnson? Yeah, Johnson definitely. All right, so I can't remember what I answered here, but let's see. B. Yeah, B is the answer there. I agree. Some of these questions I didn't word. A is actually not a bad answer. So I might give y'all kind of partial credit for ones because A is not necessarily wrong. I do agree they're in line with the industry. Yeah. But so y'all actually did pretty well. Y'all feel more confident with it? You're kind of seeing the numbers and interpretation. All right. So do y'all like this exercise? Because we can do this with turnover and margin. Is it helping? All right, we'll do this. But are you glad you don't have a multiple choice exam for the first exam? Or you? No, you don't. It's not multiple choice for the exam. No. Yeah, the exam is going to be, I'm going to give you a Word document with all the charts in order. And you can, on your laptop, open your submission for project 1. And you can copy and paste that over, but you got to change it to the words. So you don't have to worry about the template because the template's going to be there. I'll talk about the things people miss on the template. What people miss on the template is when there's no graph. When's there no graph? Well, this first thing, revenue growth. There's no graph for revenue growth, so some students forget to talk about that. But you have your paper there, so you can use that. All right. So the only issue is time. We ran out of time, so you want to get here early. And unfortunately, class after hours, they kind of like come in here fast. So I have to remember to tell the professor, can we like go to 3:55? So we got to have some time. So time is an issue. So you can't be there, you need the study as if it's closed book so that you're moving fast, because that's going to be really, really critical. All right. Any questions on any of that? So I'll put this out there on Blackboard so you can practice around with it. All right, so Walmart, we finished turnover, but I want to actually go through. We did it really fast. I want to go through. So there's only 3 things on turnover. 2 of them are really easy. One of them is a little tricky. So the first thing you just talk about is their revenue growth. So their revenue growth, I said anemic 225. That's even with that big jump. So you do need to look and see, look at the numbers and see if revenue has been somewhat bouncing around. Remember, the CAGR only looks at 2 points, 2012 and 2021. It could be one of those points is an unusual point. So look in between and see if something's going on. A few of your companies going to have a challenge because they may have done a merger, and their revenues might have jumped from 20 billion to 30 billion all in 1 year just because they bought another company. So those are kind of things you want to look at, and those are kind of side comments you might make in here. I mentioned COVID. If I was doing Valero, yeah, I might leave something in there about COVID. If I'm doing Lockheed, I probably wouldn't talk about COVID. I don't think COVID affected Lockheed. So, think about your firm and what you might add there. All right. We talked about this last time. Their revenue per square feet grew 1.33%. Their square feet grew 0.91%. So they had some good improvement in turnover with that growth rate, but not much more than inflation. So not all that strong. And then they did grow their square feet some, but not dramatically. So not anything all that impressive. The revenue per square foot is the turnover. The square feet is capacity. That's where they have to build buildings, spend millions of dollars building buildings. Make sure in this section, you have a revenue per, and you have the growth in whatever that per was. So if you're doing revenue per store, you have revenue per store and growth in stores. If you're doing revenue per PP&E, you got revenue per PP&E growth and growth in property, plant, and equipment. Okay, make sure you're consistent with those 2 things. One is turnover, one is capacity. And then you have the chart. You can see Walmart's right in line on revenue per square foot. And those of you doing Costco, you're way up here on Costco. Very much in line. Here you notice I left a 0.1 and 0.9 in there. You may or may not do that, just depending on how distorted your graph is. Okay. I almost always, on the debt graph, I almost always take out the 0.1 and 0.9 from that. The 0.1 is almost always on the 0 line, which doesn't tell you anything, and the 0.9 is sometimes way off the charts. And then the last thing is just you look at asset turnover. So asset turnover, revenue assets. Now some students struggle here because they leave the exact same words I did for Walmart. I said here, their asset turnover looks much stronger versus the industry than the revenue per square foot. You can see revenue per square foot, they're right in line with the industry, but asset turnover, they're much stronger. Don't say that about your company if that's not true. All right. So look at your company and see, is there a big difference? And you will see differences between these 2. They're not always consistent, especially if you're doing revenue per employee. Those are 2 radically different numbers. So asset turnover just looks at total assets. Employees are not anywhere in that number. All right. But you can see how they look stronger on asset turnover than they do revenue per square foot. I don't try to explain that. I just say that's the nature of it. That might be for Walmart that their square feet don't cost as much as the square feet at Macy's. Their stores are not as expensive to build as a Macy's store. So when you look at revenue per square foot, they got a lot of square feet, but those square feet don't cost all that much. So their assets aren't all that expensive. That may be the explanation. I don't know. All right. So those are the 3 things you talk about on turnover. So let's jump back to the class notes and let's talk margin here. So on margin, there's 2 types of margins. There's gross and there's net. Gross margin's fairly straightforward. You'll see it. Now you have to be real careful. Some call it gross revenue. Some call it even gross profit, which I don't like. I like gross margin. I forget what Yahoo Finance, they have kind of a strange. Oh, the markets are closed, I forget. Oh. So if we look at their, they call it gross profit. I don't like gross profit. It's just, it's real, to me, profit is the bottom part of it. So gross margin, some people call it net revenues, which isn't very good to do. One thing I will say, if you did an airline, they show a gross profit for airlines. Bloomberg does not. And I don't know why that is. So if you go to Bloomberg and you do gross margin for Southwest Airlines, it shows the NA. None of y'all picked an airline, so that's not an issue, but yeah. And I don't know why that is. I don't know why, two different sources. I don't know what Capital IQ has. It's possible Capital IQ shows the gross profit. What's in the cost of revenues for Southwest Airlines, do you think? Jet fuel, maybe? What about the flight attendant and the pilot's salaries? And I really don't know. So here's something, when you take your accounting class, I want y'all to do this. I missed out on this when I took my accounting classes. I was an accounting major to start off with. None of my classes went into detail on what this number is. So you should ask that question. Chipotle, what is in Chipotle's cost of goods sold? So obviously the meat, tortillas, the chips, the drinks. What about the paper cups? I would guess yes, but I'm not 100%. You must say, well, they're selling the Coke, not the cup, but they're selling the Coke and the cup and the ice. So I would put that in there. What about the hourly workers? Is that a cost of goods sold? So I don't know. It might be. I know USAA and banking really, really well. I know what USAA puts in its cost of goods sold. You might be really shocked what they do. There's a lot of lawyer time in USA's cost of goods sold. Why? Because lawyers do claims adjusting, and that's their cost of goods sold. So this is something when you work. So I know the cost of goods sold for banks and insurance companies because that's where I work. I can't talk about Valero or Chipotle or Walmart because I'm not really sure exactly what's in that number. So it can be really, really tricky. I think accounting classes should probably spend a little more time on what's in this number and what's not in this number. You saw with Southwest Airlines, it's a huge number. I doubt that's all jet fuel. $19 billion. I bet that's a lot of pilots and flight attendants because that's such a huge, huge number. Chipotle, I can never spell the word Chipotle. I had never heard of the word Chipotle before Chipotle showed up. CMG. Their cost of revenues is 6.5 billion and the revenues are 8.4. There's a lot of stuff in that cost of goods sold, isn't there? It must include the hourly workers. How could it not? So isn't it kind of curious? Aren't you curious what's in this cost of goods sold? Could you go to Chipotle's annual report and get a list of what all is in cost of goods sold? So it's interesting to understand that, but accounting classes don't, they just assume, what it is, whatever it is. And are the rules consistent? Just Jack in the Box and Chipotle and McDonald's all do the exact same thing on cost of goods sold. When it comes to hourly workers and all this other stuff, managers. So what's in there, what's not in there? Can you really compare to? I know with insurance, the rules are very, very, very strict. What can go in there, what can't, but there is some allocation that goes on. Anytime there's allocation, it gets a little tricky. Like for me, USA asked me what percentage of my time I spent on the Cornerstone Fund. Well, I don't spend any time on the Cornerstone Fund. I spend time on asset strategy, and then that gets incorporated in the Cornerstone Fund. So I just make up a number, 1.3% of my time. And some of that might go on the cost of goods sold, who knows? So it's there, it's a little tricky. So is it really comparable one company to another? But we're kind of stuck with whatever it is. but I wish there were more discussions. So your next accounting class to talk about cost of goods sold, you might bring up some companies and ask what's in, what's not in, what are the rules, how do you know? It would be really, really important. That's growth part. Now, net margin is a little tricky. Here's where I think we're very, very, very sloppy. I don't like the word net margin because it could be one of four things. I prefer to say, you're going to see in the charts, I actually use the word net margin, but net margin could be earnings before interest and taxes divided by revenue. It could be earnings before interest, taxes, depreciation, amortization divided by revenue. Some people use the word profit margin or net margin. Net margin could be net income. So I like to be real explicit. Am I using EBIT? Am I using EBITDA? Am I using net income? Now, there's another one out there that you hear a lot, and that's called operating margin. Have you ever heard that term before? Operating margin. So usually operating margin is EBITDA margin. Usually, not always, but most times I see people use the word operating margin, they're using EBITDA, right? Be important to know that. So you make sure you're comparing apples to oranges here. So if you're going to use a net margin, I prefer you say EBIT margin or EBITDA margin. What do you notice about the word margin? You always divide by what when you see the word margin? Always by revenue. So that makes it a simple ratio. So what I like to do is before the word margin, I like to say exactly what that margin is. EBITDA margin, EBIT margin. Gross margin to me is revenue minus cost of goods sold. That one's always the same. So gross margin is somewhat of their markup. How much does it cost them to produce something and how much are they charging over that? So you would think a company like Walmart versus a company like Macy's, who would have the higher gross margin? Macy's or Walmart? The higher gross margin. Who has a bigger markup? Walmart or Macy's? Macy's, yeah, Macy's. What about between Ferrari and Toyota? Ferrari, yeah, Ferrari is amazing. Their margins, we could even look at it. It's a pretty amazing company. Not that I buy into their products. How do you spell Ferrari? Oh, there it is right there. Race, what? Wow, great ticker. So Ferrari's got a 50% gross margin. GM has like a 7%, 8% gross margin. Yeah, Tesla is a little unusual. Tesla is they have margins that are definitely higher than the competitors, but Ferrari beats them all. Ferrari is just it's amazing. I mean, you can see Tesla is like at what, about 25%. Ferrari is at 50%. So they build a car, it costs them $100,000 to get to charge 200,000. So Tesla builds a car for 40,000 and get to charge 50,000. A little bit different. So Ferrari gets to charge a lot more for their cars. All right, so this is really, really important. You've got margin, you have turnover. So Walmart has thinner margins, but what kind of turnover? High turnover. Macy has really good margins, but what kind of turnover? Low turnover. Ferrari has great margins, but what kind of turnover? Painfully slow. I mean, there's not like 50 people in line at Ferraris, is there? Do they go a day with no sales? And if you're a Ferrari salesperson, you got a 10% commission. Do you mind if you sell a car a week? A $200,000 car a week? You're probably okay with that. You can probably live off of that, right? So that is the norm. Firms with low margins tend to have high turnover. Costco has very thin margins, extremely high turnover. All right. Ferrari has incredibly high margins, very, very, very low turnover. That's not their business. Walmart has high turnover. What about Tiffany's? When's the last time you went to Tiffany's and got a shopping cart? Any of y'all done that before? Right? And this is not going to happen. You probably don't get one in the baskets, right? You're just going to buy one little bitty thing and it's going to cost you 3 years of salary. So always keep that in mind. Thin margins, high turnover, thin margins, low turnover, high margins. What about a firm with thin margins and low turnover? That's a horrible business. What about high margins and high turnover? I don't know if that business exists. That could be Microsoft. Some of you are doing Microsoft. Microsoft has ridiculous margins. I mean, look at that. That's even higher than Ferrari. Now, anybody know what's in Microsoft's cost of goods sold? That would be an interesting number. Are there any salaries in that number? Probably so, but which ones? Whose salaries go in there and not? That's, I have no earthly idea. But that is a huge margin. And their net income margin is huge. Their net income is what, about 30% of their revenues? For Costco, it's less than 3%. So Microsoft, yeah, pretty good turnover, extremely good margins, really good profitable business, no question, really strong. All right. The second one, the net margin, it's got that markup in it because it's gross margin minus other expenses like SG&A. What is SG&A? Anybody know that? Selling, general, and administrative expenses. It's all those other expenses, marketing, all those kind of things. So when you get to the net margin, you also have how they manage their expenses, what kind of markets they have. But the most important one is this one right here. And that is their operating leverage. Okay, let's talk some terms here. I don't like using jargon. One thing I've discovered in finance classes is we teach the same stuff over and over again, and our students learn less and less and less every class because we keep changing the jargon. We don't tell them we're teaching them the same thing again, but just changing the jargon. Isn't that frustrating? It's like, I wouldn't understand this if you would tell me to use a different terms. So let's make sure we're okay on terms. So when you see the word leverage, what do you think? What does leverage do? Huh? A ramp, yeah, like a seesaw. So leverage does what? It exaggerates things, doesn't it? Makes good better and worse what? Worser. Bad, worse, bad, worse. So leverage exaggerates things. So what kind of things exaggerate things? Well, there's two things in finance that do that. One is financial leverage. We just talked about that. What is financial leverage? That's debt. A firm borrows a lot of money, have a lot of debt, they have a great year, they're going to look really profitable. Why? Because in a great year, they keep paying their debt holders the same. Your debt holders don't come back and say, hey, you're having a great year, pay us a little extra. No, you pay your debt. If you owe your bank 5% and you have a really great year and your bank says, hey, you're doing really well, why don't you pay us 7% this year? What would you tell your banker? So yeah, go jump in a lake. I'm not going to pay you more. I said I'll pay you 5. I'm going to pay you 5. So you get to keep paying them 5. You know you're making a lot of money. What happens though when you have a bad year? What does the bank say? The bank say, hey, you're a bad year. Don't worry about it. We're okay. No, they want their 5%. So in a bad year, you're losing money and you still got to pay the banker. It's going to make that bad year much, much, much worse. All right. There's also operating leverage. It also makes good years look great and bad years look bad. Anybody know? It's in the class notes. What is the key here? Anybody remember? Starts with an F. So you had a class where you did DC and FC. Anybody remember those? Anybody remember contribution margin? Yeah, contribution margin. What is contribution margin talking about? Fixed costs and variable costs. What is operating leverage? Degree, fixed cost, the cost structure. Fixed costs are a lot like debt. So you have a fixed cost, you have to pay, let's say you have these 10 salaried employees, you got to pay them no matter what. So if you have a bad year, you still got to pay them. You have a great year, you keep paying them the same you've been paying them. So it makes a great year look great and a bad year look horrible. So fixed costs. So the more fixed costs you have, the more it's going to make your net income volatile. And you'll notice that in the net margin. If the net margin is really volatile, there's a good chance the firm has a lot of fixed costs. If the net margin is very stable, the firm probably doesn't have that much fixed costs. Costco is a perfect example. I don't know if there's too many companies whose net margin is as stable as Costco's. It's just 3%, 3%, 3%, 3% all the time, straight line. And they actually manage that. So that means Costco has very, very low operating leverage. It's a very stable firm. All right, so these are the leverages. Anytime you say leverage, it's really a fixed cost. Debt is really a fixed cost because you got to pay it no matter what. It's a fixed cost. You have to pay it, but we put it under financial, whereas all the other fixed costs we call operations, operating leverage. Okay. So leverage makes us more risky. It's a measure of the relevant amount of fixed costs. A firm has high ratio of fixed costs. Increased sale will cause EBIT to increase much faster. So a firm has a lot of fixed costs. If their sales go up 5%, their net income may go up 30%. Why? Because a lot of the costs stay fixed and the revenues go up. So that's going to all go to the bottom line. You're going to get a huge increase. So the question is, what kind of costs do they have? Variable costs. What would be a variable cost for Chipotle? A cost that when their revenues go up, their cost goes up lockstep. Would beef be one? Definitely, yeah. Lettuce. What about hourly workers? Probably so, but not perfectly in step. I mean, if Chipotle doesn't have any customers for 30 minutes, do they tell, hey, can y'all go home for 30 minutes and come back when you have customers? They stay there, they still pay them. So it's not perfectly variable, but it's fairly variable. If Chipotle's really busy, they're gonna have more workers come in. If they're not really busy, they may have a shift that they shift, between lunch and dinner, where for a couple hours there's not many workers because there's not much revenue. So pretty variable. Fixed costs, depreciation is a good example of a fixed cost. It's just a cost that's always there. Salaried employees, the CEO. What does a firm do to their CEO in a bad year? They probably pay her a big bonus, right? Isn't that what we've been complaining about? Who was it? The manager just here recently, was it Goldman Sachs or someone who took a big cut in pay, or maybe it was Zuckerberg or someone. But you keep paying managers, you keep paying them the same. Some of y'all are management majors. You may have to lay off some workers, but they're going to keep paying you. So you're the fixed costs and they're the variable costs. So you kind of become, operating leverage. Fixed costs tend to be in a relevant range. So sales might grow 10%, you don't have to do anything. They grow 20%, you don't have to do anything. Then they grow 30%, suddenly you got to add a new server, you got to build a new building. So fixed costs aren't always fixed, but they tend to be fixed for quite a long range. And then you grow so fast, you got to add more to it. Most costs are either step variable or step fixed. They kind of move with revenues, but not perfectly. So it's a little bit off our mixed costs. I love contribution margin. If I were starting a new business, I would do exactly what they showed you in the accounting class. You have your revenue, you have your variable costs, and your fixed costs, how much you need to sell just so you can cover your fixed costs, that break even. It's a great analysis. The challenge is for most firms, they don't know what these things are. It's really hard to know. At USAA, what is USA's variable cost? Really, it's just hard to know that. Most of USA's employees are salaried employees. It's just a fixed salary. So it's for a firm like UTSA, it's tough. Now, some of you are going to be doing a franchise for your project. Franchises work pretty well with the fixed variable cost analysis. And so I actually have a spreadsheet. If you do a franchise, I have a spreadsheet you can use that uses that type of analysis. What are my variable costs? What are my labor costs? What are my other fixed costs? And it works well. But it's a little tough. So here's another thing you might learn in your accounting class. Have y'all learned ABC yet? What does ABC stand for? Activity-based costing. USA was really big on activity-based costing. The accountants said, we're going to change the world. Everything's going to be perfect once we get this done. I don't think they quite figured it out. I think what they did figure out is, wow, these companies are a lot more complex than we realize. Activity-based costing, that's what I had to do at USAA. When they asked me, where did you spend your time, Ron? And they give me this list of things to choose from, and I didn't spend my time on any of those things because I I spent my time asset strategy. That was my thing. Where do we want to invest? And then I just applied it to all the funds I was responsible for. Well, they wanted me to break it out. So I had this property and casualty portfolio. I had the Cornerstone mutual funds. I had all these different funds. So I just would make up numbers. So usually what I did is I just said, what did I say last month? Let me just do that. So it's really tough. You go to the CEO and ask her, what did you spend your time? Did you spend your time on this segment, on this segment? She doesn't know. I mean, it's like, well, I had a meeting with, I had a meeting with all employees. Where does that go? Is that everybody? It's just really tough. So accountants have really struggled with activity-based costing. You'll probably have, you have to take cost accounting, don't you? If you're an accounting major, you take 6 hours of cost accounting. Where are we today? Yeah, managerial accounting. The 4 level, I don't even know what that is. The 4 ABC uses: resource, department to determine why. I didn't learn that when I was in college. I had to take 2 cost accounting classes because I was an accounting major. The first one was really hard. The second one was really easy. He covered everything we did in the first one, but at a much easier level. It's like the easiest class I ever took. It was like, and UTSA was really, UT Austin was really strict on the accounting classes. It had to be 10% A's, 20% B's, 30% C's, 40% D's and F's. So to make an A, and there's 30 people in the class, I had to beat out 27 people. So in that class, it was tough. You just had to make 100 on everything because the class was so easy. But yeah, I don't know where it is now. They did not use the term activity-based costing when I went to school. So it's a newer thing. It was a big thing. I don't know where it is now. My guess is you'll hear it in your classes and study it some. I don't think it's quite done what they were hoping it was going to do. So, but that's what we're trying to do. We're trying to understand the costs of the firm. How do they move? How do they function? And that's going to affect how volatile their net margins are, how much control they have over that. If you're a pharmaceutical and you have a bunch of scientists and you go into a recession, you probably don't want to fire your scientists, because when things come back, you got to get them back. So you're probably just going to keep them and keep paying them. And that's going to be real expensive. That's a fixed cost, but they'll have those. So someone's doing NVIDIA, right? Is that Andrea, you're doing NVIDIA? Yeah, so NVIDIA has some really impressive programmers. In a bad year, they're probably not going to let those people go, because where would they go? They're going to go to the competition. So they're, so some firms, they have no choice. They're going to have to keep paying these high octane employees. So a volatile gross margin has to do with elasticity. So you'll study elasticity in your economics class. Elasticity means how sensitive are your customers to price changes. So if a product is elastic demand, you increase your prices 2% and the volumes fall 5%. Your customers are very sensitive. Inelastic, you increase your prices 5% and your volumes only fall 1%. That's inelastic. That might be tobacco. Smokers, if they're addicted, you increase your prices 5%. They have their brand. They're going to keep buying it no matter what. Inelastic demand. Why do governments like taxing cigarettes? They say it's because they don't want people smoking. Why do they really do it? Because people keep smoking and they get a lot of tax off of it, right? Because it's inelastic demand. Volatility and net margin, you pass through whatever's in the gross margin, that inelastic or elastic demand. And then it also reflects your fixed costs and variable costs. All right. So what we'll do next class is we'll definitely finish up Wal-Mart on margins. On margins, there's 2 easy ones and 1 kind of challenging one. And then we're going to do ROE decomposition. You should have done that already, probably in an accounting class. Did y'all do that before? ROE, DuPont, ROE, does that sound familiar? I'm assuming you've never seen it before, but if you have seen it, trust me, I do it differently. I'm going to show you why we do it differently in finance. I think there's one mistake account. Again, y'all need to set up this major debate between me and your accounting professor. I think the accountants make a big mistake on ROE decomposition. I'll show you. Maybe I can convince you on that. All right. Any questions on anything? I've seen like 4 of y'all so far by Zoom. So this weekend, you'll definitely want to, finalize the liquidity and solvency and get the first draft of turnover and margin done, and maybe even ROE. We'll see. All right. So we're getting close there. All right. Last class, we finished up the class notes for margins. So I want to walk through what Walmart has for margins. Two really simple things to talk about. And then one challenging one where students really struggle on this last one, especially trying to modify what I say about Walmart and say it about your company, because it's a little tough. It's a chart I like that you don't see it too often. So let's go through these. So you have two margins, gross and net. And my net margin, I don't say what it is, and I should have. So I can't even remember if I did EBIT or EBITDA. So I didn't do what I said. I should have called it EBIT margin or EBITDA margin. So I messed up with that. But the gross margin, pretty straightforward. So higher is better, higher than competitors is better. The trend going up is better. Pretty straightforward. We know even going in that Walmart, Costco, even Target, these are fairly thin margin companies. They're turnover firms. They do a lot of sales. So they don't make a lot on any given sale, but when you add it all together, especially groceries, it adds up if they have a lot of turnover. So we're expecting fairly low gross margins. And so I have a term here, very stable. It's pretty common for gross margins to be more stable than other types of margins, but it may not be true for your company. You have to look at that, but it is pretty common. You can see with Walmart, very, very stable right at 25%. In fact, they probably manage right at that 25%. It's well below the industry, but you somewhat expect that because they're a discount store. You expect them to be lower. I have Macy's and Nordstrom's in here along with Costco and others. So, you know, very thin margins. Whoever's doing Costco, you're probably this low or even lower. It's just very, very thin margins, 25%. So they buy stuff for $100 and then sell it for 125 or whatever. You know, it's a 25%. It's not quite the math, and maybe just sell it for 120, but you know, they make about 25% on each sell. That doesn't leave you much room for selling, general and administration, marketing, all that other stuff. You're not left with much to work with, but you know, you expect that. So yeah, they're definitely below the industry, but I'd expect that. Look at your firm. Don't automatically assume if your firm's below, that's what you expect. So think about your firm and what you would expect. So for Walmart, its gross margin is in line with its history. It's well below the industry, but I say that's expected. So Parisa, I would assume Macy's is above the industry, because I would assume when I go to Macy's, I'm getting good customer service. It's a really nice environment. They're selling higher end stuff. Yeah, they probably charge more, but I don't know how much. So I would guess, I don't know if you look at yours, I would guess they'd be above the industry, but their turnover is going to be much lower than Walmart's. But that's the kind of thing you normally see with the firm. So pretty straightforward. Where are they versus the industry? If it's just a flat line, then you can say very stable. We normally, gross margins are stable. Net margins tend to be a little bit more volatile. Here's though where Walmart might not be so far below the industry. So their gross margins probably going to be pretty thin. But then Walmart's really going to control expenses after that point. And so their net margin consistently below the industry, but they have been in line with it. So it looks like the gap is not as big as it is on, you know, there's a 10% difference on the gross margin, less than a 5% difference, and they've even caught up a little bit. So yeah, they're below, but they're not radically below like they were on gross margin. I mean, Costco this is almost Costco's line right here. If you take this little dip down here, Costco is just like the 3% company, always 3%, well below everybody else. But in Costco is the turnover king. So you gotta excel in something. They excel at turnover. So Walmart's somewhat in between a Macy's and a Costco, probably closer to Costco than Macy's. But so is it disaster that they have really low margins? No, that's their business. That's their business model. You could also use the word stable here. That's a pretty stable number, especially when you see the entire industry really, really got hurt with COVID, and Walmart somewhat held their own and caught up. So now this last one. All right, so this last one's tough. I don't know how let's talk about it without talking about it in the Walmart yet. So let's think about this term, economies scale. Does that have meaning to you? You probably heard that term before. Anybody have an idea what that might mean? You have economies of scale. So economies of scale, if revenues grow 5%, earnings should grow more than 5% or less than 5%. Your revenues are up 5%. What do you think earnings would be? Up 5%, up 10%, up 3%. What would you get? If you have economies of scale, what would you think? All right, so I'm gonna go the opposite of what y'all are thinking then. So let's see if I can convince y'all of this. To grow faster than 5% as more fixed costs, not more fixed costs, as fixed costs are spread over more sales. Remember, you have fixed costs. If you have fixed costs and your revenues go up, what do your fixed costs do? They stay the same. So if your revenues go up and your fixed costs don't change, what should your earnings do? It should grow much faster. That's what economies of scale are. If you have economies of scale, as you grow, some of your costs don't move. So as your revenues go up, your earnings grow really, really fast. That's economies of scale. And that's what I'm after in this chart. Unfortunately, most of your companies are not going to cooperate. Most of your companies are going to be like Walmart, where their revenues are growing faster than their earnings, somewhat implying that they don't have economies of scale. I don't think that's true with Walmart. I do think Walmart has economies of scale. What I think is going on with Walmart, though, is the competition, especially from Amazon, is so harsh that essentially they're taking that economies of scale and giving it back to the customers with better pricing. So I think Walmart has economies of scale, but they're passing it on to the customers because of the competitive framework. And that's probably true with Costco. So you would expect most of your companies, if revenues grew like that, you would expect earnings grow even faster because you have fixed costs. All right. So that's the key. So what if you have like Walmart? I would say I'm not seeing evidence of economies of scale. I think they have it, but I think because of the competitive landscape, they're essentially giving that back to the customer. And my guess is probably 70–80% of your companies are in this world. I've got Costco loaded, so we can look at Costco. So see, Costco's the exact same thing. Revenues. No, Costco does have economies of scale. So whoever's doing about 4 or 5 of you are doing Costco. You can see earnings are growing much faster than revenue. That implies Costco is showing some evidence of economies of scale. So they may be one of the exceptions. So is it good or bad? You know, the question is, are they taking advantage of those fixed costs as their revenues grow? They can grow their earnings faster because they keep those fixed costs there. So that's what we're looking for. It's kind of a tough thing to talk about. Let me see if I can find another company here. Let's see. Sorry, I think I've got. Well, let's try Disney. Who's doing Disney? I can't remember. Okay. Disney's they're in the news today. They had something report today, kind of interesting. And I think they're losing subscribers, aren't they? Which is kind of interesting, as young as they are. I mean, as young as they are in their subscriber business. Yeah, so that's a pretty wild one. They were showing economies of scale until 2017 and just has not gone well since then. There could be some COVID in there because that 2019 could be June 2009 through April 2020 or something. And if they shut down all those theme parks, there could be some of that going on. I think ESPN has been struggling, so who knows what's going on. So obviously COVID, if you have COVID happen, you can make your revenues just really, your revenues might be flat and your earnings could just crash. So obviously no evidence of economies of scale there because obviously something happened in 2019 to disrupt this. So you're just not seeing that. So a lot of your firms are going to be in this spaces. So you want to express it in some way. You know, most firms have fixed costs. They should reflect economies of scale where their earnings grow faster than their revenues. However, as you can see for Disney, while that was true until 2017, maybe because of COVID and the lockdowns, earnings took a significant drop in 2000, something along those lines. We'll get you through that chart. It's a tough chart to talk about, no question. So for Walmart, I said EBITDA is growing 0.2%, much lower than revenue growth. You can use some of this sentence here. One would expect the firm's EBITDA to grow faster than revenue due to basic economies of scale, fixed cost spread over higher revenue. So this one sentence you might be able to keep verbatim into your paper because that's going to be true for all companies. And then with Disney, you're probably going to start the next word with however, next sentence with however, given the current comparative, but you may not say the current competitive environment. You might say due to the impact of COVID or something like that. Obviously, Disney, a big part of Disney is travel and leisure with cruise lines and theme parks. But with Walmart, I said, given the current environment, both revenue and EBITDA have been difficult to produce consistently above general inflation. So yeah, it's been a tough for Walmart. I think they're doing pretty well against Amazon. One thing I say with Amazon is they're not very profitable. They're big and they're growing fast, but their retail business doesn't make them much money. So Walmart is competing against a firm that's willing to not make much money to compete. And Walmart, I think, has actually been doing fairly well. I hear more and more people going to Walmart's website to buy stuff because they can drive by Walmart and pick it up. And that, you know, there's more Walmarts than there are Whole Foods, so it does give Walmart a huge advantage. Although Amazon's building more and more warehouses, I'm really shocked. The first time Amazon delivered something the same day I ordered it, I was like, this is kind of crazy. And that's happened a few times. It's just like, this is ridiculous. How are they doing that? So I don't know their entire model. It's getting better. It's pretty impressive. But Walmart does have that advantage that there's just so many of them. They're just everywhere. So it gives them a little bit of an edge. So do your best on this one. This is one, you know, at some point, if you want to talk, you know, do a Zoom with me, you probably want to highlight the sections you're struggling with so we don't have to go through the entire paper. And this might be one we want to talk about and try to get some help just on your company specifically. All right, so just a reminder where we've gone. So liquidity, you have three things to talk about there. One really easy one, how fast is cash from operations growing? One really tough one, net working capital. One a little struggled is finance. Debt, pretty easy, times interest earned. Is it above 10? If it's not, is it trending up? Debt to EBITDA, is it lower, getting better? Is it below the industry? Those kind of things, pretty straightforward. Then you have a conclusion where you talk about the credit ratings and the Bloomberg rating. You have a summary. Then you talk about revenue. You have two easy ones, revenue growth and asset turnover. And then you have the more challenging one, capacity versus turnover. Then you have margins, net and gross margin, real simple. And then revenue, how much of that revenue is getting to the bottom line? If their revenues grow 5%, are their earnings growing 10%? The economies of scale. I should call this economies of scale. All right. Anything in yellow is not part of the grade. It's just how much the three parts are. Those add up to 15%. So ignore the 15%, the yellows. So where do we go now? You do have to do a summary on asset turnover and margin, but it's really pretty simple. First of all, you can multiply those two numbers, asset turnover times margin. You can just look at that. So remember, Walmart was really strong on turnover, weak on margin, but when you combine them, how do they look? That's what we want to look at. And then you want to just have a summary. Well, your summary is essentially going to go back and look at what you said on asset turnover, look at what you said on that margin, and just bring out those most important pieces. So it's really repeating what you've already done. So with Walmart, To summarize the long-term prospects, remember you summarize the short-term prospects by looking at their credit ratings. To summarize the long-term prospects, I bring Walmart has been, now, I have a lot of students that keep the wording for the company exactly the same as what I have on Walmart. Don't do that. Go back and look. So before you write this section, in fact, you don't even look at what I wrote for Walmart because it's going to throw you off. Go back and look and see, how did my company do? Where were they strong? How were they on asset turnover? Were they above the industry, below? Were they rising or falling? How were they on net margin? Were they above industry, rising or falling? Know that before you get to this section. And if I were you, I would just essentially delete this entire thing and just write it freehand, because all you're doing is summarizing really two charts. Chart 12 and chart 10. That's really what you're doing here. And then we multiply those two charts by each other, asset turn times margin. So in this section, you're essentially going back and summarizing charts 10 and 12. Don't say everything you said, but bring out the biggest pieces. Okay. So especially strong on this, but weak on this, but maybe they're really strong on asset turnover, but net margin's improving. That may be what you want to say. Or maybe they're really strong on asset turnover, but it's been weakening. So wow, they're really strong here, but boy, the last few years it's been coming down. Those are the kind of things you're looking at. You just look at the charts and see what you can say. So you can see Walmart's been really pretty stable on net margin, although it has declined somewhat here recently. Asset turnover above the industry, obviously on asset turnover, it has declined some here recently. So I just look at those charts and just say, you know, strong here, weak here, and I have some summary overall. We can see that Walmart is consistent in line with industry median on asset turnover tons margin. They're right in line with the industry. They and the whole industry have been coming down. Why? Because it's a lot of competition for Amazon. Right in line with the industry. So those two balanced out, the high ATO and the low margin, the two combined, they're right in line with the industry. Walmart is working on its online presence. So here I'm just making up stuff. So you have, you know, if you know some stuff about your company, you may throw that in there. So I somewhat hinted at this with Costco. If you go to YouTube and find the CEO of the company and see if you can find their CEO talking about the company, you can in 5 or 10 minutes get a really good story that you can throw in here, because CEOs are really good at working crowds. So, you know, what are they saying about their company? If you want to, you don't have to, but you can, if you know off the top of your head what's going on here, you can certainly do that. Lockheed is what, Jacob or Kai? Jacob, right? Jacob, I'll get it one of these times. So Jacob, you may be talking about Ukraine, and I mean, Ukraine's, well, it's horrible for Ukraine. It's great for Lockheed because everything they're producing is getting destroyed, so people have to replace it. So he might talk about the Ukraine and war and countries around the world, you know, just China, Taiwan, there's all these conflicts. That's great for someone who's building defense. That could certainly be talked about here. All right. So that gets us to the next one, which is ROE. So we got to get through ROE. This one can be a tough one, but let's talk through it. You've probably had some of this in a previous class, but we do it a little differently in finance. So a profitability ratio, what we're doing there is we will say, okay, they're profitable, but are they profitable relative to how much their investors invested in this company? So the most popular one is called return on equity. What is their net income compare to how much the investors, the stock investors have invested in the company? And return on equity is pretty simple. It's just net income divided by owner's equity or shareholders net worth or book value net worth. There's so many terms for owner's equity, but just net income over owner's equity. So the viewpoint is from the stockholder's standpoint. And what we want to know is our firm doing well? Well, you got to be careful here, because return on equity can go up for good reasons and it can go up for bad reasons. And so what we're going to do is try to decompose, it sounds terrible, but decompose return on equity so we can separate the good stuff from the bad stuff and figure out why the company is doing what it's doing. And so the easiest way to do this is to bring together those charts I got Disney. Why not use Disney? So what are the charts we're really interested in here? Well, chart 10. Chart 12. Chart 16. Chart 15. For this part of the paper, you might want to actually put those four charts together, and you'll see why here. I am going to do a little editing so I can see it a little bit better. This is a good place where the 90th percent and the 10th percentile are probably not going to be your friend. Right, so for Disney, you see a huge drop in return on equity, actually went negative. So Disney lost some money. Their asset turnover fell, their net margins fell even more. And yeah, so you've got an issue we're gonna have to see with Disney. I'm gonna have to explain this. There's a problem here with this chart. So here's a chart where I would actually, and I've already forgotten who's doing Disney. Okay, sorry. Here's a chart where I would actually go into data for chart building. And on the combined financial leverage from my company, negative numbers are a huge problem on this chart. So on chart 16, you see how they have a negative number right there. I would just get rid of it. That helps it a little bit more. All right. So essentially in your conclusion, you're going to bring these together. You've already done these two, right? We just talked about margin and turnover. So you've already gotten those. You know why they're moving. So you can see for Disney, their asset turnover times margin is going to be coming down both because turnover is declining, net margin is declining. So there's probably a lot of COVID going on with Disney there. But why else is ROE coming down? Well, their leverage also came down. So this is a good thing. This is a good thing. This is a bad thing. You want these to go higher and you want 16 to go lower. All right. So that's how you have to look at this to try to figure out what's going on. So there's one company. Let me do another one because that's kind of a strange company. Let's try Costco, a little bit cleaner company. So I'll bring in chart 10. Chart 12. Chart 16. And chart 15. Now we know Costco is very, very strong on turnover. They're actually even a higher, I mean, it's amazing. They're above the 0.1%. So they're essentially number one. We know they're going to be terrible on margin, but extremely consistent. And on combined financial leverage, I don't know, I can't remember. So they've been really high on leverage, but consistent, whereas the industry has come up. And on, oops, return on equity. They've been right in line with the industry. So this is a really good example. Asset turnover, really strong and pretty consistent. Net margins, very consistent, actually rising a little bit. I'm probably using EBITDA here. I can't remember because it's usually right at 3%. Financial level, very comfortable. So here's the point I want to make. Costco is kind of the perfect one. Someone might look at this and say, wow, Costco used to be ahead of the industry, but boy, in 2021, they fell behind the industry on ROE. But why did they fall behind? Well, part of it is because the industry has a lot more financial leverage, and that's going to cause that to go up. So part of it's not anything to do with Costco messing up, is that the industry's more risky. They're more levered. All right. The industry did catch up on its margins, whereas Costco just stayed the same. So you really, at this conclusion, it's a matter of finding these charts to try to explain what's going on in chart 15. And chart 15 is essentially chart 10 times chart 12 times chart 16. There's only one thing missing that I tend to ignore, and that's the tax impact. If you want to bring the tax impact over just in case it's something major, you can. I'm hoping the tax impact is like Costco, and it's somewhat of a non-issue. I don't know why they would do that. Higher means less of a tax impact, but we did get a tax law change in 2017. I don't know if you remember the Trump tax law change. So that may be why they've gone from going up. So they have had some improvement because of the tax law change, but hopefully that's not a big part of it. All right, so let's look at the class notes. That's just to set it up. So how can we break this out into different pieces? So here's what return on equity is. Return on equity is asset turnover times margin times tax impact times the financial leverage impact. So let's see if you remember these ratios. Asset turnover is sales divided by assets. Remember that? Anytime you see the word turnover, you're going to have something related to revenues in the numerator, and whatever in the title is in the denominator. Here it's sales. So asset turnover is sales over assets. Higher is better, lower is worse. Okay. Margin. There's several different types of margins. Here we're going to use EBIT. Remember, anytime you see the word margin, you divide by sales. So EBIT, higher is better. Okay, and on your paper, you multiply ATO times margin to summarize that long-term outlook. The next one is net income over earnings before taxes. What's the only difference between net income after tax and net income before tax? What you pay in taxes. If your tax rate is 30%, this number should be 0.7. Essentially, this is how much of your income you keep after you pay tax. It should be 1 minus your tax rate. You could see with Wal-Mart, it was about 0.65 and then it went to 0.75. Why? Because the Trump administration and Congress reduced the corporate tax rate. All right, so we're hoping you can ignore this one. It may not be too stable because of the tax law change, but it's going to probably be in that 65 to 75% range. That's not true for everybody. Have y'all heard of Carnival Cruise Line? So if you look at their financials, their pre-tax net income way back here was $3 billion. Their after-tax net income was $3 billion. 71 over 30/60. That's a tax rate of like 2%. Carnival Cruise, if you look at their tax impact, it's like a straight line on 1. It's like they don't pay any tax whatsoever. You'll see the same thing with other cruise lines. Why is it they're just unique? First of all, they have a lot of tax deductions because they get depreciate their ships. But I don't know if you've ever been on a cruise. You are too young to be go on a cruise. I'm old enough, and they're really boring things. But yeah, there are certain things they don't open until they hit international waters, and then they open them up. That may be to avoid taxes. But yeah, there's some companies that are really strange. So tax impact for Carnival Cruise is just non-existent. Right. And then the next one, the financial leverage, has 2 pieces. EBT over EBIT. The difference in these two is interest expense. What's his earnings after they pay the interest expense versus what's their earnings before they paid interest expense? Now, is anyone doing Lululemon? Can't remember. You are. Okay, so Lululemon has no debt, right? I don't know if you noticed that. So that means this number really should just be 1. because they don't pay any interest expense. So there is no impact. But if your firm has a lot of debt, this number is going to be really, really harmed. It's going to be really low because you're going to pay a lot of interest expense. All right. So this number is going to be really related to how much debt you have. And then the second part is financial leverage. So here we're looking at assets over net worth, and that's the leveraging impact. Assets minus net worth is all your liabilities, which includes debt, but it does include other things. So, so McKinsey, you will have a number here, even though they have debt, they do have other liabilities. So you will have that leveraging effect. You just won't be harmed by having to pay interest. So it's kind of like all your liabilities are like free. You don't have to pay interest. So it's a great leveraging effect. So firms that have more debt, they're going to be hurt here because they have to pay interest, but they're going to be helped here because they can get more leveraging. But this leveraging increases return on equity, but not for a good reason. It increases it because the firm's more risky. They're more levered. Remember that word leverage we talked before, financial and operating leverage. So this is the part of the equation that helps ROE go higher, but for not a good reason. It's just more risk. Okay, so this is the piece we want to break out. Now, in your accounting classes, they may have just done sales over assets times net income over sales times assets over net worth. So you might have learned it this way. They did asset turnover exactly the way I did. But here's where I really disagree with them. They didn't break out the tax piece, and they didn't put the interest expense piece over here with the leverage. And I think that's going to give you some really bad numbers. So I think you can't just use net income. You've got to take how much is interest expense, how much is tax. We want to bring those two pieces out because they're really unique parts of the business. All right. But other than that, this is real similar. I mean, it's almost the same formula other than me breaking out this piece. I break this piece, the margin piece, I break it into three pieces. The net margin, the tax impact, and the interest impact. Okay. So do y'all remember this from your accounting class at all? Has it been too long? That sound a little familiar. So there may be some finance accounting professors that don't do it this way, but everyone I've seen, the ones that teach the EMBA, that's the way they do it. So I think they're mixing too much stuff into one number and just a little bit exaggerating it. So I like to break it out in more pieces, but it's the same thing. Asset turnover and margin, those are the ones you want driving that ROE. If your ROE is going up, you want that ATO times margin going up. So look for that. That's where management really adds value, by increasing turnover, increasing margins. If they do that, they're making the business more valuable. They're not making the business more valuable by borrowing a lot of extra debt and leveraging up the firm like that. That doesn't make them more valuable. And we'll see later when we talk about cost of capital, when a firm leverages up with more debt, the return on equity goes up, but so does the required return. So their stockholders might say, hey, we need a 10% return, and management's making 9%. So they go out and borrow a lot of money, and now they're making 12. And the stockholders say, well, that's fine, but now you're more risky. We don't need 10 anymore. Now we need 13 because you're more risky. So it's like they're chasing their tail when they use debt. So this is where the stockholders want management increasing the return on the firm. So that's really what you're looking for. So when we looked at Costco, very, very stable here, and actually slightly coming up here. The return on equity has been coming up. It looks a lot of it is coming from the tax law change, but some of it is coming up. A lot of this rise really is some improvement in the net margin. So I would probably give them pretty good marks. One thing everybody loves about Costco is just the predictability. It's the firm knows what it's doing, and it just keeps doing it. You know, just every year after year after year, you know exactly what they're doing. They add a certain number of stores every year, 50 stores, whatever. They're real consistent in what they do. Is that boring? No, the stock market loves boring sometimes. It makes it really, really fun to buy because you don't have to worry about them blowing up on you. All right, so that's return on equity decomposition. You'll notice sales divided by sales cancels out. EBIT divided by EBIT cancels out. EBT divided by EBT cancels out, and assets divided by assets cancels out. So you're still, oh, I didn't cancel this one out. EBIT divided by EBIT. So you still end up with net income over net worth. And I have students say, well, why are we going through all this trouble? Well, the reason going through all this trouble is ROE might be higher because of bad reasons, or it might be higher because of good reasons. It could be lower for good reasons. Your ATO and margin might be even improving, but the firm got rid of a lot of debt, reduced their leverage. You could say, well, ROE is down, but it's down for good reasons. The firm's not as risky as it used to be. If Lululemon started borrowing money, their ROE would shoot up, but not for good reasons. Okay. ATO and margin is almost return on assets. It ignores the tax impact, but if the ATO times margin is greater than what the firm's paying on its interest expense, then more debt's going to increase the ROE. It always will. So if their ATO times margin 7% and they're borrowing at 4%, the more they borrow money, their return on equity is just going to keep shooting up, not for good reasons, but for bad reasons. All right. This one's tough. I think a lot of students struggle on this because you got to look at all the pieces, and most of your companies are pretty complicated. They're all over the place. So you have to kind of look at it. Something you can do, it's a little tricky, but if you look at print page 1 on line 43, it has that whole formula. And so if you're looking at Costco, their return on equity went from 18% to 28%. And so you might ask the question, so let me show you what you could do. During that time, their combined financial leverage went from 2.5 to 3.1. So how much impact does that have? So let me show you a little trick. What if their financial leverage was the same as it was in 2012? Their ROE would not have gone to 28, it would only gone to 22. But that's still pretty good, isn't it? 18 to 22. Y'all see what I did there? So how much is that 28% due to their higher financial leverage? Well, let me just make the financial leverage the same, and it shows you that number. Same thing on asset turnover times margin. What if their asset turnover times margin was the same as it was several years ago? The ROE would have been 23. So it looks like about half of their improvement ROE was due to improvements in in turnover and margin, and about half of it was because of the higher leverage. It's about 50-50. Half of it for good reasons, half of it for bad reasons. So you can play around a little bit with it. Even the tax impact, what if the tax impact was the same and there it didn't have any impact because the tax impact at the beginning was the same, about the same, and then it dropped. Remember, on tax impact, higher means they're paying less tax because this is essentially 1 minus their tax rate. So if you want to just kind of gee whiz, it's hard to tell looking at the charts what's having more impact, one versus the other. You can play around with this part of the spreadsheet. Just remember to hit Control-Z after you do it before you start moving charts in, because that'll really mess up your charts. Okay, tough stuff, but actually this is really, really important stuff here, especially when you take your capstone class. You don't want to look at ROE and just assume that tells you the whole story. You really got to step back and say, hey, what's going on with this firm? So let's look at this. This is my overall summary. I'm going to turn on the return on equities, and this is where a lot of students leave way too much Wal-Mart language in their paper. Okay, I think in these sections, you might want to just delete the entire Wal-Mart section and write it all from scratch, so you're not tempted to try to, this isn't a section where you can just change the numbers and everything else works. Even if you're doing Costco and Walmart are real similar, but in this section, you're probably going to have to do a radical rework. Walmart's overall return on equity has been continuously in line with the industry, except for 2017 and 18. 2017 and 18. It did fall below the industry in 2021, but this is driven more by the industry's significant increase in leverage, more than a relative deterioration in turnover and margin. So here you see the industry's huge increase. So we saw that same thing with Costco, huge increase in leverage. So yeah, the industry shot up, but it mainly shot up because it became riskier. Therefore, Walmart's lower relative position in 2021 is not a serious concern. So essentially what you're going to do is try to explain this chart while looking at those other 3 or 4 charts I showed you. Just try to get your hands around it. It is tough. And it really is tough because there's just so many moving parts. It really does make it difficult. You might be better off looking at print page 1. Print page 1, starting line 43, might be easier to deal with than the actual charts themselves, because then you can see the actual numbers. So like if margin goes from 2.9 to 3.4, you might say that's not much, but that's a fairly significant increase. It's an increase. That's like an 18% increase. So that's pretty good. That's a pretty significant one. Their turnover went from 3.47 to 3.5. That's only a 2% increase. So you can see for Costco, the improvement in AT all-times margin is really coming from that margin improvement, even though it's still pretty, consistently 2%, but going from 3%, but going from 2.9 to 3.4 is much more impressive than going from 3.47 to 3.54. So from a relative side, so you can do little tricks like that to you're trying to figure out what had the most impact, and you can do little tricks like that to figure that out in here. So you might be better off doing that, but I would still set up this sheet so you can see them all together. You're trying to explain this chart 15, and it's the combination of these other 4 charts. Okay, questions on this one? So this weekend, I would say get it drafted all the way up to relative value, because we probably won't finish relative value today. So I wouldn't worry about relative value at all this weekend. It's the one I grade the easiest because we're just going to hit the surface really quickly. But see if you can draft all the way through ROE this weekend. If anyone wants to set up Zoom times, it worked pretty well last Sunday night. I just set up one Zoom, and then when one person finished, I just emailed the next one and say, hey, jump in anytime. So we could do several Friday, Saturday, Sundays. So if y'all want to, if you want to sit with me on Zoom, what I highly recommend, because it's going to take forever if we go through every single sentence in your paper. So I would recommend that. I think gross margin, net margin are pretty simple. They're pretty easy. You're just saying, is it better or worse, getting better or worse? That you highlight those sections you're most concerned with, so we can really bear down the time just on those places you're concerned about. But this weekend be a good time, because we're getting closer to do that date in a couple of weekends. So you want to get as much of it done this weekend as possible. So you see where you're going.
We also talked to you in the financial center on the first floor as well.
Yeah, I'll be there today, like at 4:45 till 7. I won't be there tomorrow. Monday, I'll try to get there by 2:30 or so on Monday. Yeah. Today I got here at 1:30, but it depends on where I park. I had to park way over there, and I sprinted here, so I get here by 1:30, but I may be a little late. All right, so I want y'all to get this down. The exams, I think at least 2 weekends after the papers due. That gives me 1 weekend to grade it, give you comments back, and then you can prepare. We'll talk about the exam. One thing I'm worried about the exam is time. Some students, this takes quite a bit of time. And so what I've done in the past that has worked pretty well is get another room. Like there's a room in the library that we could start like at 2 and go to whenever. But it depends on if you have a class. Does anyone have a class both right before and right after? And here, Andrew, yeah, so that may be an issue. Is the class like at 15 minutes afterwards? And it's your other classes ends 15 minutes before. Or you have work. Well, we'll see. I mean, well, I hate the rush hour, I mean, but it will be somewhat of a rush. The fact that you can type it in words can probably help, because you probably can type faster than you can write. And you'll have all the graphs there already in the document. But yeah, we'll see. I'm worried if we're in here, the previous class is going to rush us, and the class, I mean, it's going to cut into our time. So we'll see. We'll talk about that as we get closer. But time could be an issue, which means you need to come into the exam as if it's closed book. If you're trying to look stuff up in your paper to try to remember that, that's just not going to be good. You gotta have it so that you can just start writing real fast. So, all right. So we got one last issue to do for the paper, which is a little challenging, but I don't grade it too picky because we're not going to really get into it enough. But it is important for finance majors to know this, especially. So under class notes and PowerPoints, there's one called relative value. So I'm going to start this one today. We'll kind of get into it. Did I mark the colors correct here? Does that seem right? Or any greens should be reds? Well, y'all can let me know if I need to recolor it, but there are a lot of greens, especially once you get past liquidity. So there are some oranges down here at the end, so it can get a little tricky. So we're going to do this last one. It's 10%. So we're going to do relative value analysis. I have a whole PowerPoint that I've done that I like to use. Relative value used to not be taught in colleges at all. It was just ignored because tenured professors, they don't believe in it. But everybody uses it in practice. Dr. Demadera, and I stole some of his stuff in this presentation because he has a really good YouTube video on this. He used to not cover it, and then he would ask his students, are you going to use what I taught you in class? And, oh yeah, we're going to use that we taught in class. And so then he decided to go talk to some alums and discovered they weren't using what he taught in class. They were using relative value analysis. He said, okay, well, if the 100% are not doing what I taught and they're doing this, we should at least teach this. But then he said, if I'm going to teach relative value analysis, I'm going to make sure we're doing it correctly and we're not making a lot of the mistakes industry's making. So we're going to get into relative value analysis. See if I can get in the slideshow without hitting the escape key. So there's 3 approaches to what we call valuation. All right, so valuation is how much you think something's worth. And then you're going to decide where you're going to buy it. So like I bought a bunch of Meta stock a few weeks ago. It hit 90 bucks. I thought, wow, that's really cheap. They were a 10 PE stock. And I thought Facebook Meta should be a 20 PE stock. I thought it was going to double. So I bought it. So what valuation I used? I used the relative valuation there. Costco. I love Costco, a great company, but their EV to sales is way too high for a firm with those thin margins. So I don't buy Costco. What analysis am I doing? Relative value analysis. So I use it a lot, but there are 2 other approaches. We're going to cover one of the approaches in this class and the other one we won't cover at all. But before I cover it, I'm going to go back to something you're much more comfortable with, which is real estate. You use relative value analysis in real estate all the time. It's very, very normal to do. It's just the way real estate people think. It's the way you think. If you buy a house, you're going to use relative value analysis. So I just want to start with something you're familiar with, and then we'll talk about it with companies. And then we'll say, okay, if you're going to use relative value analysis, what's the right way to do it? And then we're going to talk about the common approaches so that you can say, which one should I use for my company? I give you 3 relative values, 4. I have to give you 4. And you got to pick which one makes the most sense for my company. And you'll probably, at the end of this presentation, you'll know, so you'll know which one to pick. Some of them are really, really straightforward and obvious. And that's going to come down to what industry you are. So Costco is going to use EV to sales. Lockheed's probably going to use price to book. Boy, I think of I can't remember what companies are doing, but KLA is going to use EV to EV the EBITDA. So it's going to be obvious. You're going to see when we get there, you'll see what industry you are in. It's going to be obvious. So we'll do that. And then I'll give you some examples of, I mean, Brian could teach this part of it where you can actually build models and use this to do stock screenings, right? You did that last semester. You can come, you had the short list, didn't you, to get that far? Have you done that? So yeah, you can build the entire model, get a short list and actually buy stocks if you want to. So here's the three approaches. There's fundamental analysis, which we're going to do in a few weeks. There's technical analysis and relative value analysis. Right now, we're looking at relative value analysis. You're not going to do any fundamental analysis in paper one. So fundamental analysis is when you, fundamental analysis is when you take what you did in paper one and you try to figure out the value of the firm. It's using discounted cash flows. So you forecast Walmart out 50, 100 years, and you figure out what that's worth in today's dollars. Doing the stuff you do in paper one, except for it's taking what you do in paper one and then forecasting it out forever. That's fundamental analysis. We'll do some of that. Technical analysis is you're looking at price behavior. You're trying to say, hey, is this stock on a trend? If it's on a trend, I'm going to jump in and finish the ride on the way up. Is it overbought, oversold? When Facebook jumped or Meta jumped 20-something% in one day, the question, well, hey, was it overbought? There's something called overbought. It's called the RSI, the Relative Strength Index. And it showed that Meta was overbought. That was too fast of a price movement all in one day. So that's technical analysis. I don't do that at all in this class. I do technical analysis, my secure analysis class. That class has 9 papers, and one of them is technical analysis. It's one of the 9 papers they do, but we don't do here. Have y'all heard the term chartist or charting? Stock charting, that's what the technical analysis is. Now, most universities throw that out as useless, but there's some pretty prominent professors that teach technical analysis. Dr. Dahlquist here at UTSA, she used to teach technical analysis and wrote a really good book on it. She's not here anymore. She moved on some other places. Dr. Lowe, one of my favorite professors at MIT, he wrote a really good book on technical analysis. He's a big believer in it. So there's some pretty good heavy hitters that do believe in technical analysis, but most universities throw it out as you know, it's just trying to read the tea leaves or whatever. It just doesn't work, but that's their argument. And then relative value, more and more schools are teaching relative value analysis just because it's just so dominant. It's just out there. I saw a graduate student in her capstone class, and she had a big project, and it was all relative value analysis. So when you do y'all all take capstone, or is that only the finance majors? Do y'all have a capstone class where you bring everything together? Or is that just finance? So I'm never really sure. So, and your capstone class is a good chance you have a major relative value type of analysis. All right, so before we do that, let's talk about real estate. So what is relative value analysis? You're going to take the price, some kind of measure of the price of this thing, whether it's a piece of real estate or a stock, and compare it to some fundamental thing, like its earnings or its revenue or its square feet. All right, that's what we're going to do. We're going to take a market value driven thing and compare it to more of an accounting or, you know, a real documented kind of thing. So that's the fundamental factor. So relative value has 2 numerators and a bunch of denominators. The 2 numerators are either price or enterprise value. So what you have to figure out is, are you going to use a price related one or enterprise related one? There are some ratios that use price that would be wrong. Price to sales is wrong. There's some that use enterprise value that would be wrong. So enterprise value to earnings would be wrong. You don't have to worry about that because I don't give you any wrong ones. All the ones you have in your Excel are correct ones, but we'll talk about what are the wrong ones and why wouldn't you use them. What's the fundamental factor? It can be a bunch of things, but the 3 most common we're going to deal with are earnings. I'm going to give you net income and earnings before interest and taxes, revenue, and book value. Those are the 3. So for your company, you're going to have to decide which ratio do I use. Do I use price to earnings? Do I do enterprise value to revenue? Do I do price to book? Do I do enterprise value to EBITDA? You have to decide, and I'm gonna walk you through that. It really will be really obvious once we finish this, which of those ratios you should use. All right, so there's where we're going. What relative value says is essentially the stock market itself, the real estate market, they're not overpriced, underpriced, but real estate or stocks within the market might be underpriced, overpriced. And that's what we're trying to do. We're trying to say, hey, stock market's fine. I don't think it's bad, but is Meta expensive versus Apple? Is Meta expensive versus Google? Or Alphabet. That's what we're looking for. Okay. Or as you're looking at 5 houses to buy, which one looks mispriced versus the other? Is there one looks really cheap, one looks expensive? That's what relative value is doing. Now, if the entire real estate market's overpriced, this is not going to help you with that. So, but even then, let's say you're in a real estate market that's overpriced and you're looking at 5 houses, you would still want to buy the house that's the cheapest, though, wouldn't you? Relative to everything else. I don't mean cheap as far as poorly built, but the least expensive one. So if the real estate market's overpriced and it's going to correct, at least if you buy a house that's not materially overpriced, it's going to protect you some. So that's going to help you even in a bad market. Unfortunately, the terms we use I don't like are cheap and rich. Cheap is good. That means your stock is inexpensive. I wish whoever, we're stuck with these terms because they have a long history with them. But I wish whoever came up with the word cheap would have said inexpensive. So it's really inexpensive and expensive. They use cheap and rich. I don't know why. I don't know who makes up these terms. All right, so there's where we're going. So we're going to start with real estate. So Andrew, are you the only real estate major in here? Other real estate? Are you? Or kind of double major? Okay. So real estate loves relative value. So let me give you an example. Let's say you're looking for a house. Your broker calls you and say, hey, I got a house for 150. I'm in a hurry. I don't have much time to talk. Do you want to buy it? You're like, well, can I? No, I don't have time. 150, take it or leave it. What do? You're going to buy it? That's all you know. Price of the house. And you ask your broker, well, is it good? I don't know. I hadn't time to look at it. I don't know anything about it. $150,000 house. Probably not going to do anything with that, right? Your broker says, oh, well, wait, I can give you a little more information. There's 2 other houses in the same neighborhood. One's going for $875,000, one for $675,000. Do you want to buy it? Yes. You're already saying yes. I'm thinking, what are you really thinking? Yeah, why is it so cheap? I actually would ask what's wrong with it, I think. I mean, wouldn't that be the first question? What's wrong with it? Isn't that, I mean, there's obviously something wrong with it. All right. Now, Jacob's probably thinking, well, it might be a horrible house, but I can tear it down and build another house because obviously this is a really sought after neighborhood. But you don't know, this could be in California, it's up on a cliff and it's about to go off the side in a mudslide. So, it could be that you're a little bit more tempted now. Why? Because you do have at least houses in the same neighborhood. So well, that neighborhood must be pretty nice. Well, let me give you a little more information. Let me say this house is going $75 per square foot. The other 2 houses are going for $250 and $225. So that $150,000, you could say, well, it's one of those tiny houses. Well, we can adjust for that now. We look at how much it costs per square foot. Now, would you buy it? It's getting a little more tempting, isn't it? It's pretty cheap per square foot. Well, price per square foot is a price relative. That's how you can compare a 3,000 square foot house to a 2,500 square foot house. You look at price per square foot. That would be pretty helpful. Certainly better information just knowing the price. So first we got the price, then we got the price and the neighborhood. Now we got the price, the neighborhood, and a relative. We're still wondering, why is this house so cheap though? And so you go to your broker and say, okay, here's all the factors that are important to me. I put it into a model and I want you to run this house against that model. Here's all the things I think are important. The size of the house, we already got that with square feet. Does it have a pool or not? I don't like pools, so if it had a pool, that would reduce the value to me. Number of bedrooms, the quality of the kitchen, that might be important. How nice is the landscaping? When was it last painted? How old is the house? That could be important. That $150,000 house might be, 40 years old, where the other houses are brand new. When was the last time the floors were replaced? Age of the roof, that was a big one. Me selling my mom's house, the guy buying it, who's just adamant there have been hail damage. And I was like, that's your problem. You have your inspector. I don't think he actually had an inspector. I think he inspected it himself, and he kept telling me he had an inspector, and he didn't. My realtor found stuff he didn't find. She's like, you realize there's these major cracks in the wall, because I didn't live there. I didn't know anything about it. So well, his inspector didn't say anything. I fixed all that stuff, but yeah, the roof, that's $50,000. If you need to replace the roof, and it was 40-year-old roof. Age of fences, that's not quite as expensive. The garage, you need a 2-car, 3-car garage. How nice are the schools in that neighborhood? Those kind of, I'm sure there's other things there, and there's actually models out there you can get on the internet that will actually let you do this. That's related to value. And then I wanted some stuff related to risk. This is kind of, Jacob, my comment in California. There's a floodplain, or there's houses that are just, the ocean's taking over. Are there foundation issues? So my parents' house, yeah, they had a major foundation issue. However, the firm that built their house admitted they made a mistake, and they paid for it all to be fixed. And the firm that they had fixed it gave us a guarantee for life, and that firm's still in business. And I had that guarantee, so I could show that to the buyer and say, hey, if anything does happen, they fixed it 20-something, 30-something years ago. We haven't had any issues since then, and we have a guarantee. That's somewhat clear that issue. But still, if you have a house that they tell you had serious foundation problems, but we fixed it, you're still a little bit worried about that. You might care about where the fire department is. I don't know about that. Or neighbors. I've seen some houses that their value goes down because of the neighbors. Yeah, I probably have seen those annoying neighbor shows. That can be bad. If your neighbor's house is not kept up, or it's been vacant for a while, those kind of things, that's just is not good. I saw one guy, his neighbor, he didn't like his neighbor at all. And so on the day she was showing his house, her house, he had a big kind of a, big party with people dressed terribly inappropriate, lasting the entire day with loud music, and just to irritate her. It was kind of interesting. And then this lawyer is asking, could she sue him for doing that? That's kind of interesting. But so if we take all of these factors and put it into a model and look at all the houses we could see, we can get an R squared of 91%. Do y'all remember R squared from your stats class? So R squared tells you you've got this one thing, price of the house. We have all these factors. How much do all those factors explain housing prices around the city? And I got a 91%. So those factors explain 91%. There's 9% that I didn't pick up. And maybe I can't pick that up. Maybe that's just noise. Just buyers have different tastes. But I can explain 91%. I looked at 350 houses. And based on that, this house should be going for $150 per square foot. I can get it for 75. Remember those other two houses? They were 250 and 225. This house I could get for 75, but it's not as nice as of those other houses, but I could still, it should be going for 150. And I can buy it for 75. Now, would you be willing to buy it? Yeah. Sounds like enough information. You still probably want to see it, but if you're one of those, buy and fix and swap, this would probably be one of those good swap houses. Well, let's run the model. Let's see if we can get the R squared a little higher. Let's get up to 98%. We had two other things to it. We go out and ask if anyone was murdered in the houses, and ask if the house has been haunted. I just saw a video today on Facebook. These mansions that can't be sold because supposedly it's haunted. I don't believe in ghosts. It wouldn't bother me, but you probably, if you knew it's haunted, your mind would probably play tricks. There's a lady in Helotes. At last one party, I don't live in Helotes, but I ride my bike there every day. So they know me as the guy on the bike. That's just me. So they invite me to their parties. She was talking about her house being haunted, and I started to laugh because I thought she was joking, but she wasn't. She was serious. Really good storyteller, but she thinks her house is haunted. And I was like, well, don't tell anybody that, because you won't be able to sell it. So let's think about that. Let's say you want to buy this house for 75. It's really worth 150, but when you adjust for these two things, the model says it's really only worth 80. But these are two things you don't care about. So you got a house you can buy for 75. For the things you care about, it's worth 150. To the things that everybody cares about is only worth 80. Do you buy the house now? And I think it depends on how long you plan. If you plan to live there for 20, 30 years, then yeah, you're buying a house that's worth 150 for 75. You may have to sell it within 2 years. What's going to happen when you sell it in 2 years? The buyers are going to know about it, that it's haunted, that something happened. They're only going to offer 80. And so then it may not be worth it. And this is the same thing with stocks. You might look at 40 factors for Microsoft and you think Microsoft is worth a lot more, but there's two other factors that the market's looking at that you don't think is important. You're going to have to take that in consideration. You might say, well, the market won't care about this in 2 years. So I'm going to go ahead and buy it. I'll hold it for 2 years, then sell it. That's what you got to think about. You're trying to figure out what is the market considering, and then ask if that's important to you. And then if you're going to hold, if you're like Warren Buffett at Berkshire Hathaway, I don't care what the market thinks. I'm buying Dairy Queen. I'm going to hold it forever and ever and ever. I just want a good business. Or Northern Railroads or Geico or Fruit of the Loom, what all Berkshire Hathaway owns. He was owning Apple there for a while. Says, I don't care what the market's looking at. I'm looking at what I think it's worth, and I'm just going to go with it. That's that 150. If Andrew was asking me if I was a day trader, what do day traders care about? They care about how the stock moves quickly. So they can't be those long-term investors. They do have to care about what the market thinks today, even though it may not be important tomorrow. Right. So this is how relative value analysis works. And you're really trying to figure out what is driving the market, what is the market thinking about, and how might that change. So a good example, I had a person I used to work with at UTSA. He's now moved on. He's a tech analyst. He came and spoke to my security analysis class. And so we were talking about Apple. And he was a big investor in Apple back then. Apple was much cheaper back then. And Apple was somewhat losing its game. And the argument back then was Apple had these incredibly good margins. And the whole market said, well, Samsung's pretty competitive. There's other competitors coming in. There's some Chinese companies coming in. Apple's margins are going to really get squeezed. And his argument was, I think the market is absolutely wrong on this. They're misinterpreting what's going on with Apple. And their margins are actually going to not only not get worse, they're actually going to improve some. So he had, now this is, if you're in finance, this is how you get your boss excited. You say, this is what the market thinks, and this is why I think they're wrong. That's when portfolio manager gets really excited, because that's what they're looking for, right? So that's what my idea on Meta was, I think the market's absolutely wrong on Meta. This is why, that's what a boss wants to hear. And so that's what you're looking for there. So his argument was Apple's margins are not in decline. Well, the nice thing is that belief, he was going to be proved right or wrong within 2 quarters. It wasn't going to be over the next 10 years, in the next 2 quarters. And sure enough, the next 2 quarters, Apple's margins did great. And he owned Apple and the stock shot up, and he won that with his boss. So that's good. So that's what you're trying to do here, is get some insight into your company. So you have insight to your company. You just looked at their liquidity, their solvency, their turnover, their margins, their return on equity. Now you're trying to decide, is this a good company or a bad company? Now what you're going to do is look and see if the stock market agrees with it. All right. So you want to see, is this stock expensive or is this stock cheap relative to what you're thinking? All right. So it ignores whether the overall market's cheap or rich. It's just trying to figure out, is that one house looking cheap? And it did. We could get it for 75. We think it's worth 150. So the key for relative value analysis is you're going to take some price, some value, and you're going to adjust it for fundamentals. How many rooms? Does it have a pool? You're going to adjust it for risk. You want to look at some factors that are maybe generic to all industries, but the better you can do is to look at specific to your industry type of ratios. And that's what you're trying to do. The more specific you can get to the industry, the better insights you're going to get. So that might be, you're looking at 350 houses in Texas. It might be better to look at 40 houses in San Antonio. Might be better analysis because the markets may be really different. Same thing here. Industries can really vary quite a bit on these numbers. So all three have to be there. The right price relative, whether it's price or enterprise value. The right fundamentals have to be there and right risk. The reason you can really mess up on this is if you only look at price and fundamentals, you might find a stock like Kroger's and say, wow, Kroger's looks really cheap. You don't realize that Kroger's has a whole lot of debt right now. And it's not that they're cheap, it's that the market's stock price is down because the market sees them that really risky. So if you don't adjust, but if you adjust for that risk, then you quickly say, oh yeah, they're not really cheap, they're just really risky. So you got to make sure you have both of those in there. So the goal is to use the independent variable, which are all those fundamentals, to try to forecast the dependent, which is the value of the firm. We did that with the houses, right? We took the pool, square feet, all that stuff, and we try to guess what the house is worth, and we came up with $150 per square foot. We then compare that to the actual. You can do this exact same thing with Microsoft. You can take all these factors, and you say, wow, Microsoft should be trading for this. Oh, look, they're actually trading for that, and you can make a buy or sell decision on that. Good fundamentals should mean higher stock price. Higher risk factors should mean lower stock prices. So a good example of this. So I don't want to get into it yet, so we'll get into this next class. But let's look at my favorite one, since Carissa is doing this one, is Macy's. So the stock market has a price to earnings right now of about 20. So you're paying $20 for $1 earnings. So let's look at Macy's. Right now with Macy's, their price to earnings ratio is 5. The stock market is 20, Macy's is 5. The stock market on average, you have to spend $20 for $1 earnings. For Macy's, you only spend $5 for $1 earnings. If Macy's just holds their earnings constant the next 5 years, you get all your money back. Whereas other stocks invest, it could take 20 years unless their earnings grow pretty fast. That is a very cheap stock. Then we can look at a Tesla. Tesla's PE ratio is 57. You have to spend $57 for $1 earnings. That's a very expensive stock, huh?
It was 150 last year.
Well, yeah, it's come down quite a bit, no question. And then you look at a Costco. That's an expensive stock, but it's also a very low risk stock. So we do expect to spend more for Costco because they're very low risk, but should we spend that much more? So we got to adjust it. So if we adjust Costco for risk, we find that they should be more expensive than the average stock, but not that much more expensive. So that's where we're going with all this. All right, I'll let you out 2 minutes early. So let me know, email me if you want to have time this weekend.